Luke Boyenger is the CEO of Cruzumi CFO and Advisory, specializing in fractional CFO services for construction companies. With deep industry expertise, Luke helps businesses enhance profitability, optimize cash flow, and achieve long-term financial stability. Today, I just wanted to start with Luke. How can contractors project their cash needs to make sure that they have enough capital to fund projects and the costs of running a business?
Yeah, great question. I love this question because I think it's super important. And I see so few businesses really putting themselves in a position to be able to even do this effectively. And I think it really comes down to a couple of things. Number one, you've got to have some kind of timeline for your jobs. The projects that you're working on doesn't have to be perfect. And in fact, it should be adjusted throughout the life cycle of that project, especially if your projects are longer term in nature. If you're doing 9 to 12 month construction projects, you've got to have a timeline in there of this is when we think we're going to start. This is when we think we're going to be done, and have some milestones built into that project. We're going to have the foundation built out by this date. Then we're going to have the structure erected by this date. Like, kind of timeline it out. Then you assign costs that you're going to incur in achieving those milestones to those milestones. Now you've at least got an approximation of when you're going to incur the cost to complete that project over the timeline of that project. Do the same thing with the revenues. When are you going to bill? Are you billing a fixed amount every month? Are you doing cost plus? What's your billing structure? Map that out to the timeline as well. Now you've got a job level cash flow forecast of here's when expenses are going to go out on the jobs. Here's when revenue is going to come in on those jobs. Always try to make it to where the revenue is funding the expenses, not you're funding the expenses and then collecting the revenue on the backside, which I know that's how it works a lot in the construction industry. But if you can get in front of that, even better. So now you've got, for every job that you're working on, you've got a timeline, you've got your expenses mapped out, you've got your revenue mapped out. So you have now forecasted cash flows at the company level through revenue, cost of goods sold, getting down to gross margin. But to your point, there's more to cash flow than just operations. There's the overhead of the company as well. There's your sales and marketing activities and just all the admin that goes into running a company. This is where what we do is we do a 12-month cash flow forecast for our clients. And we look at the last 12 months of spend by category and overhead. And we use that to project what we think the next 12 months is going to look like. And this is not as simple as writing an Excel formula and dragging it down and then drag it over 12 times for 12 months and bam, you're done. There's more thought that has to go into it than that. You have to take into consideration your goals and objectives for the next 12 months also. Because if you spent $5,000 a month in marketing in the last 12 months, your Excel formula is going to tell you to budget $5,000 a month in marketing for the next 12 months. But that doesn't work if you know that you're going to double down on your marketing spend to try to drive some business growth and revenue increase in the company. You don't want to just budget based off historical. You want to use historical as the context, informed by your strategic goals that you're pursuing over the next 12 months and forecast based on that. So you'd forecast $10,000 a month for marketing over the next 12 months. And that's just one example, but you go down through category by category in the overhead portion of the business. What have you spent historically? What are you planning to spend over the next 12 months? Forecast it out, add it to what you already did for revenue and cost of goods sold, job expenses and cost of goods sold perspective. And that gets you pretty close to being at a company-wide cash flow forecast. The only thing left to do at that point is take into consideration balance sheet impact, because there are oftentimes things that happen on the balance sheet that impact cash, but they don't show up in the profit and loss. So a good example of that would be depreciation on fixed assets, payments on debt balances. Those things hit the balance sheet, not the P&L. Or they hit the P&L, but they need to be adjusted for cash purposes because they aren't cash transactions. So establish timelines on the jobs, project revenue and cost based on those, forecast out 12 months of admin, and adjust for balance sheet activity. You now have a 12-month cash flow forecast in place in your business.
Can you walk me through? We've talked a little bit about P&Ls, we've talked about balance sheets. There's this third document called a cash flow statement. Can
Yeah.
you walk me through kind of like what that is, why that's important, what that isn't, and kind of like how different parties use that to inform decisions?
Yeah, they print it off and throw it in the trash because nobody knows how to read it. That's what most people do. No, I'm joking. But honestly, the statement of cash flows is probably one of the least understood financial statements. It can seem really complicated and confusing, and it doesn't make any sense. And why does it exist anyways? And it doesn't tell people what they think it's telling them. I like to explain it like this. The statement of cash flows is really telling you why net income isn't cash. That is really what the statement of cash flows does. So you have a profit and loss that says you have $1 million in net income. You go over and you get really excited and you look at your bank account and say, cool, I'm going to see $1 million in the bank. And you open it up and there's like 100 grand in there. And you're like, what the heck? My P&L says I made $1 million. Where did it all go? The statement of cash flows is what explains that. It explains why that $1 million of book profit has not yet translated to cash. Or conversely, that you open the bank account and there's $2 million in there. You think, why do I have so much? Statement of cash flows answers that question. It reconciles cash to profit.
When contractors realize that they have an upcoming gap in their cash flow, which happens often in construction, what are the next steps?
There's two things I would say primarily. One, if you have a cash flow gap, where especially if you have a cash flow gap that's going to put you into the negative from your actual cash balance perspective, then that usually means somebody's not paying you that needs to. You need to go run an accounts receivable report immediately and go out and pick up your phone and start making some phone calls and getting some of that money collected. That is usually what is happening. Now, sometimes it's not that. Sometimes you just are operating within payment terms that aren't very favorable. You've agreed to maybe some 60 or 90-day payment terms, and it's just creating a cash flow shortage. And to that, I would say if you're going to take on projects with that kind of a payment delay, 60 to 90 days, you absolutely must have sufficient line of credit in place to be able to get you through those payment terms, where you can draw on that line of credit to cover your cash flow needs in the short term. And you collect on those invoices, you pay that line of credit back off. It costs a little bit of money to do it that way. So I always say too, if you're going to do those types of jobs, take on that kind of work, make sure you're pricing the cost of that line of credit into those jobs, or you're going to be left holding the bill.
For contractors that are just now taking on bigger commercial jobs that maybe haven't experienced the like make or break, if you don't have enough money on hand, you go out of business sort of situation yet, what would be your like word of warning to them? How can they avoid getting into that sort of situation?
Don't pursue that kind of work until you're ready for it. And by ready for it, I mean you have a healthy cash balance in place. If you're running a $20 million construction company, you got 100 grand in the bank, you're not ready to take on those kinds of projects. You haven't done the legwork to put yourself in a position to be financially ready to take on those types of projects. You need to commit some time to being really effective, really efficient, building up a cash buffer in your business so that if you take on a larger job and the payment is slow in coming, it doesn't bankrupt you and put your business under, because it can. It absolutely does. A great example, one of my large clients, they're like a $50 million revenue construction company, and 10 or 15 million of that was from one county in their state. I believe they're doing some work on a courthouse. And from the time they invoiced to the time they got paid was months, because the project happened to fall during the county's annual budget review cycle. So the county was not allowed to issue checks and make payments to vendors for like 90 days until the budget was set and approved for the next year. If you don't have a couple $1 million in the bank to float you through that big of a period of time while you're waiting to collect $10, $15 million, you're going to end up and a whole lot of trouble. So I know those projects are tempting, and if you can win them, you want to, but just make sure that your company is actually prepared to be able to take on that kind of financial risk.